Welcome to The Explainer. Today, we are diving deep into one of the world's most critical and, most complex software giants, SAP. We're going to unpack its incredibly high-stakes trillion-dollar bet on the cloud. So, let's get right into it. How does a 50-year-old tech company suddenly start getting treated like a hot growth stock? Well, the answer is tangled up in one of the biggest, most expensive transformations happening in the business world right now. And that whole story is hitting its climax as we speak. All right, first things first. To really get what's happening with SAP now, you've got to understand just how much of a behemoth this company has been for decades. For as long as most of us can remember, SAP has been the digital backbone for the world's biggest companies. I mean, think about it. It's the software that lets them ship products, pay their people, and close the books every quarter. It's not glamorous, but it is absolutely essential. And this has created an incredibly sticky customer base because, let's be real, ripping out your company's core ERP system is like performing open-heart surgery. You just don't do it unless you absolutely have to. But that old model, the one built on selling these massive one-time software licenses that made them a fortune, well, it's being completely upended. The future for them and everyone else is the cloud. And that means a massive shift away from those lumpy, project-based revenues to the nice, steady, predictable drumbeat of recurring subscriptions. And look, this isn't some far-off 5-year plan. That number, 83%, that's the slice of SAP's revenue that is already predictable as of 2024. This is hard proof that this huge company-altering strategic shift is already happening. It's reshaping their entire financial foundation right now. So you might be asking, how is SAP pushing this change so fast? Well, they're using the single biggest catalyst in their recent history, and it's a catalyst they created all by themselves. Pay attention to this year, because from an investor's point of view, 2027 is the key to this entire story. For thousands of companies all over the world, this date isn't just a suggestion. It represents a massive spending event that they absolutely cannot put off. So here's the deal. SAP is officially pulling the plug on mainstream support for its old software. You know, the stuff companies have been running on their own servers for years. That ends December 31st, 2027. This basically forces their entire massive customer base to upgrade to their new cloud platform, S/4HANA. Sure, they can pay a ton extra for a few more years of support, but the writing is on the wall. Move to the cloud or get left behind on unsupported tech. Let's be really clear here. This is not a polite suggestion. It's a hard deadline. It's a forcing function, as they call it, designed to make every single one of their legacy customers make a move. And that, in theory, kicks off a multi-year wave of big money projects that SAP is sitting right in the middle of. Okay, so you've got this monumental transition. How on earth is SAP actually managing it? And more importantly, if you're an investor, how are they making sure their customers don't just jump ship during this really vulnerable time? Well, what they've done is actually pretty clever. They've packaged the whole thing into two main offerings. You've got Rise with SAP, which is this all-in-one service designed to basically handhold their giant existing customers through the move to the cloud. Then there's Grow with SAP, which is a much leaner, ready-to-go version aimed at snagging brand new customers, especially in the mid-market. And their strategy gets even smarter. They're not just selling the software for the move, they're literally building what you could call a moat around the migration. They went out and bought companies to control the whole journey. They bought Linux to help companies plan the move, and then they integrated WalkMe to help train all the employees on the new system. It makes it that much harder for a customer to even think about going with a competitor. And of course, you can't talk tech today without talking AI. SAP is weaving it into everything. They're not just tacking it on either. By putting their AI assistant, Joule, right into the workflow, they're boosting the value of their cloud stuff and giving customers a whole new, powerful reason to make the upgrade. Okay, the plan sounds solid, right? But, and this is a really big but, especially if you're looking at this as an investment, this is absolutely not a done deal. SAP is facing some major threats. And speaking of threats, you don't have to look much further than their old arch rival, Oracle. For the first time in what feels like forever, Oracle has reportedly caught up, or maybe even edged slightly ahead in yearly ERP revenue. This just goes to show how ferocious the competition is, right at the exact moment when SAP's customers are being forced to decide on their future. Now, this whole shift to the cloud also creates some, let's call it short-term pain for investors. You can see it right here in this chart, what they call the margin J-curve. Basically, SAP is trading its incredibly profitable old support contracts, we're talking 90% plus margins, for cloud subscriptions that are, for now, less profitable. The whole bet is that as they get more customers on the cloud, those margins will climb back up. But it's a temporary hit that Wall Street is watching like a hawk. And all this leads to what might be the biggest risk for an investor, the value trap. The entire bull case rests on that 2027 deadline being a powerful enough force. But if adoption stays slow, you have to worry that customers will just delay, maybe start looking seriously at competitors like Oracle or Workday, or just try to limp along with their old systems. That would undermine the whole growth story. So, with everything that's going on, with all these high stakes, how should an investor actually keep score? How do you know if SAP's grand plan is actually working? Well, the bull case, the argument for SAP is pretty clear. It's all about their powerful competitive moat, those crazy high switching costs we talked about, and the strong belief that the 2027 deadline is going to work. If it does, it should unlock years of faster growth and, down the road, much better profitability, especially with AI creating new ways to make money. So what are the actual numbers you need to be glued to? First is the S/4HANA adoption rate picking up steam. Second, look at the cloud backlog. That's a great predictor of future revenue. Is it growing fast? Third, are those cloud margins starting to tick up, proving they're getting more efficient? And finally, is the company showing it can grow its profits faster than its sales? These are the metrics that will tell you if the strategy is just a nice story or if it's really working. So, at the end of the day, it all comes down to this one huge, multi-billion-dollar question. SAP has laid out its plan, the deadline is set in stone, and the competition is circling. Will their massive, loyal customer base follow them into the cloud, or will they decide to forge a different path? The answer is going to define the future of one of the world's most important tech companies for the next decade.